Hello, everyone, and welcome to the latest LPL Market Signals. Jeff Bookbinder here with my friend and colleague, Jeffrey Roach. How are you today, sir?
Hello, hello. It is a Monday as we're recording it here, and so far the week has started out well. We got a few more days to go, though, right?
A few more days to go. Well, hopefully the retail sales data or the Fed don't ruin what so far is a good week.
Right.
So thanks for joining, Jeff. Sorry we took the week off after our national conference out in San Diego. Took a break, and now we're back with you. So thank you, Jeff, for joining. Here's our agenda. We're just going to recap last week. It was a really interesting week because of the move higher in interest rates. Next, we're going to talk about the Fitch downgrade. We would have talked about this last week, certainly, because it happened on August 1st. But we'll cover that. And we actually wrote a weekly market commentary on that topic on the U.S. debt situation. Certainly an important, but maybe not so pleasant topic. And then last, I already teased it, right? Retail's the big story of the week with the Fed minutes. And next week is Jackson Hole. So let's get into it, Jeff. Here's the headline for the week. Stocks struggle with rising rates. You mentioned it's Monday. It's Monday, August 14th, as we're recording this, and these returns are through Friday, August 11th. So we had a little bit of a down week for the S&P, down 30 basis points, not much. The weakness in the NASDAQ, though, stands out. And so, on the one hand, you might think, well, tech's had such a great run, it needs to pull back. Right, valuations are high, and certainly some of the tech leaders. And we would generally agree with that sentiment, but I think rising rates was really more of the story last week. We'll show you a chart of the 10-year here in a minute, but it was a pretty big move, up near last year's highs on the 10-year. Part of this is related to what Fitch highlighted, that the U.S. debt situation isn't getting any better. But it's also related to the soft landing narrative maybe catching hold. So we had some losses in the bond market, and then we had, which we'll show you in a minute, and then we had some losses in the stock market. Anything else here jump out at you, Jeff, to highlight?
Well, it's interesting. We look at 1 week, 1 month, 3 months, 6 months, and it gets a little bit dangerous when you try to tell a story in shorter time frames. But, after the CPI on Thursday last week, and then the University of Michigan sentiment survey on Friday, it's interesting. Thursday, Friday, some moves within cyclicals. Now, that didn't necessarily hold up for the whole week, but I think the markets are still trying to figure out, the data is fairly solid. There's not a lot of hard data that's confirming the story that eventually the consumer will run out of money for the spending splurge they're doing. The survey data is what people are holding on to, people like me, for example, that eventually the bill comes due. And so it's been tough. Markets seem like that soft landing might happen. Inflation is cooling, but really that last mile getting down to the 2% might be a challenge. And higher rates certainly been a little bit of a damper.
Oh, no doubt. Something else that's been a bit of a damper is China, right? The reopening has been a big disappointment. They're struggling with a property real estate crisis. So you saw China's market lose some ground last week. You saw weakness in industrial metals, very China tied. So that's certainly something we're watching. LPL Research continues to be underweight emerging market equities. So here's bonds and commodities, and you see the industrial metals index down 3.5%. Copper's down this year. The energy sector actually is really natural gas driven. Crude oil didn't move much last week. It was really a natural gas story, but that helped drive energy sector gains. The top performer last week. I guess on the bond side, other than just losses in high quality bonds as rates rose, I think the resilience of high yield is interesting. Of course, high yield offers attractive yields. Maybe that speaks to the resilience of corporate America, a theme that we have heard a lot about during earnings season. certainly. High yield's not an area we're focused on. We like preferred securities better within the fixed income universe in terms of credit. But I think high yield's resilience is notable. So let's turn to the stock market here, Jeff. This is the S&P 500, and I got some support levels from our chief technician, Adam Turnquist, and drew some lines on here. I think, the first takeaway here is that there's a lot of support for the S&P 500, just a little below where we're at. We're a little bit above this as we're recording. This is Friday's close, 44.65. The support levels from recent highs and from the, sort of support from the maybe the June pullback. There's a number of levels here that could keep us above, let's say, 43.50 for a while, maybe 130 S&P points down. But we think that actually this pullback could go a little further, so maybe we'd be watching the 4,200 level for an ultimate low. Potentially that would probably be a dip that we would be buying. So we'll see how far it goes. I mean, the next support level is the 50-day moving average around 44.40. But we've kind of been bouncing around here the last couple of months. The good news when you bounce around is you create support. But of course, the bad news is you don't make any progress. So, our neutral equities kind of fits with the technical story. Maybe we need to be sort of choppy and sideways. So let's look at the 10-year yield real fast here. I mean, this is a simple story, right? We are really close to the highs of last fall. And if we break through those, we're going to be at 15-year highs on the 10-year Treasury yield. So this is something that the stock market's going to have a tough time digesting if we keep going higher. Jeff, what would you say, is sort of the mix of causes of higher yields? Do you think this is, the market kind of reacting to Fitch? Do you think it's, the digestion of all the Treasury issuance? Do you think it's soft landing or something else? All the above?
I think we make a pretty decent case that it's not Fitch, or at least it'll at least shrug it off a little bit, relative to comparing, with the S&P downgrade in 2011, which we'll talk about in just a little bit. I think in terms of where you want to rank, the key catalysts for this rise, I think it's that soft landing narrative. I think it's kind of interesting when you think about yields on the 10-year relative to what we're seeing in high yields. We kind of hinted at it on that screenshot a little bit earlier in the slides. It's this unusual period where I think, there might be a little bit of interest for investors to take risk off the table. We saw that in the equity numbers and the techno kind of support levels. Perhaps there might be a little bit more interest for investors to take a little more equity risk off the table. But I think there's a little bit of that unknown about, coming through 2023. Things look very strong. We're slowing down, no doubt, especially as you look at labor market. But it's that unknown about what the rest of Q3 and Q4 look like. And fixed income investors need to be compensated for that risk.
Oh, yeah, absolutely. I mean, we like the bond market as much as we have in a very long time. So that means that we are, comfortable with the yields here. If we thought yields were going to go much higher than this, we certainly wouldn't be as comfortable with bonds. So, combination of the Fed being close to done or done and inflation coming down, we think will put downward pressure on rates. But in the very short term, sure, we got a lot of Treasury issuance to digest. And then we have the budget concerns that were raised by Fitch. So, we don't want to sound bearish here because we're neutral, right? Neutral equities is not negative. Actually, this slide probably supports being fully invested because these drawdowns here are not, particularly severe. So this is a study that Adam Turnquist did looking at how big drawdowns tend to be after a strong start to the year. So he ran this on August 11th, broke the year-to-date returns down by deciles, and then looked at the maximum pullbacks that you get within each decile. So we're in decile 2, I guess, up 16, 17% for the year. The average drawdown is only 6.5. Heck, we're almost halfway there already. And people haven't even noticed this
Mhm.
pullback. It's been so limited, right? So, maybe we have a little bit bigger than that. To get to 4,200, you would need a little bit bigger pullback. The point here is we can still have a solid gain for the year. We can end the year higher than we are this right now, but still have a high single digit pullback. So when that high single digit pullback potentially comes, don't be too alarmed. I think this is a really good message to pound to investors. Actually, kind of related to this, the average drawdown in any given positive year is 12%. Right? I bet that's bigger than a lot of people would guess, based on data back to 1950.
Jeff,
Yeah.
I think you hinted at it earlier. I think when you look at the numbers and you look where we are and the path on which we traveled since January this year to where we are today, I think it does make the case for staying invested. And I love that title you did. I think it was a blog post maybe several weeks ago now, where we moved to a neutral relative to benchmark weighting for equities, but that's not a negative view, right? It's just a management of the risk and the choppiness. And I think the other thing I'd say, it's interesting when the recent drawdown in the last week or so really hasn't garnered a lot of attention. Seems like, and perhaps that's because we've developed so much support at these levels where we are, S&P 500.
Yeah, I don't think this pullback went more than like 2.5%. So it's the Nasdaq was a bigger pullback, but the S&P, it's been very limited. So I think the soft landing narrative gaining hold, good earnings season generally relative to expectations. That's been part of the story, but we've also had this steady decline in inflation, right, Jeff? I mean, this is part of the story too, right? That's got investors maybe reversing their calls for another bear market or pulling back on recession fears.
Yeah, I think one of the things I'd highlight just for our listeners, reading from left to right, don't get too concerned about the details of the numbers. Just look at your colors, right, from red to green, except for gas prices, but pretty much everything else, red to green, meaning there's an improvement. One of the things, Jeff, I haven't highlighted enough, but I probably need to start beating on this drum, and that is, in 2020, when the Fed held their virtual Jackson Hole Summit, that was all kind of modified this 2% target. And the rephrasing of it was a long run 2% average. And so I think it's so helpful to think of that modest tweak, which turns out to be a pretty, life-changing in the sense that you think about post-great financial crisis, we've seen core CPI, core PCE deflator, one of the Fed's preferred metrics of inflation, stay below 2%. So when you get it above 2% and we're still above the 2%, remember that the Fed talks about this long run average. So it's hovering. Sometimes it's going to be below, sometimes it's going to be above. So I think it's a really important point to remember, because we could get to this stage in this current cycle where the Fed pauses, even though inflation is slightly above their 2% target in the near term, because it's about a 2% long run average target. So people don't think about that enough, I think. But I wanted to highlight the Jackson Hole Symposium from 2020 because I think it preps us well for the upcoming Jackson Hole 2023, which is I think the 24th, I believe, which is a Thursday, and goes into the weekend. But important to think about and really remind folks in how the Fed views the inflation target. Key takeaway here, though, just to boil it down, key takeaway is inflation is easing. Hey, look, excluding housing, the latest July CPI number is 1%. So, it's clearly going in the right direction. And we know that the Fed will take a long run average, not just a month snapshot on that inflation read. So that's the key takeaway.
Yeah, 100%. So I think something like 90% of the increase in CPI was housing, if I'm not mistaken. I mean, it's a big housing story for sure. So thanks for that, Jeff. Let's go into earnings. Some of the stuff I've already shared 2 weeks ago, the last time we did the podcast, right? The story has not changed dramatically. We were surprised at how much upside then. We were surprised at how resilient estimates were then. Well, we still are, right? The beat rates, you're looking at the earnings dashboard, 80% earnings beat rate is better than we've seen in recent quarters at this stage. The upside surprises on average are about 7 points, similar to last quarter, but certainly I think a bigger upside surprise than most people thought. Coming into earnings season, consensus was looking for down 7% S&P 500 earnings. If you take out Merck, which is 2 points, we're down 1.6 now. So that's quite a bit better. We've got a little more ways to go to get the last few companies out, but we're going to be pretty close to flat ex Merck. Then you take out energy. Energy is a 7% drag, roughly, a little less, but about that. And then you're up, let's call it maybe 6% when all the numbers are in, 5 to 6%. That's not bad. That's a pretty good underlying earnings power for what is a very tough environment for companies in terms of margins. Now, perhaps the most impressive thing about this is that estimates for the next 4 quarters have risen. So we just hold Q3 of 2023 through Q2 of 2024, right? Look at those estimates when earnings season started. Look at them again now. They're up 20 basis points. That is extremely rare. So estimate resilience is actually, that story is even gained steam over the past couple of weeks since we talked to you last. So I'm very impressed. Corporate America's done a great job of managing margins, and we're back to near 220 in consensus S&P 500 earnings for 2023. When just a few months ago, a lot of people were talking about 200 or 205. There's just virtually no chance we'll be down there that low at this point. So we're at 213, and we actually think we're now maybe a little bit too low. What do you think, Jeff? To what do you attribute such strong earnings relative to expectations?
Yeah, I like what you said, estimate resilience. And I think we've seen it from the firms managing their labor costs. Perhaps that's adding a little bit of support here. Of course, the consumer's still been spending like crazy, so it's they have pretty decent markets, and perhaps still a little bit of pricing power. That may erode just a bit, but certainly managing costs has certainly been pretty helpful from the bottom line.
And certainly productivity statistics for Q2 were pretty strong too, right? And that kind of feeds into the point you just made, right? Earnings have been
which actually is a good little bit of a teaser when we talk about projections into 2025, 2026 as it relates to budget as a percentage of GDP. We got to keep those productivity numbers high enough in order to support what we might think in the next couple of years. That's just a little bit of a teaser for highlighting this week's weekly market commentary.
The segue master right there at work. Well done. So yes, we're going to talk about the U.S. debt situation. Fitch, of course, shined a light on this by downgrading the U.S. government debt rating, and then that followed, as many of you remember, the S&P move in 2011. So, naturally, when we got this headline, some people got nervous. We get it, right? The market dropped almost 20% in 2011. And the S&P downgrade was certainly a big part of why. So let's just talk about, Jeff, some reasons this is different. Here you see the 2011 chart of the S&P 500, and you look at that collapse. I mean, it wasn't all the S&P move, right? I mean, that was a challenging time coming out of the great financial crisis, and we had the European debt crisis raging. Remember, we talked about Greece all the time?
Right.
about it now except as a vacation destination, but we're not talking about Greek debt and the solvency of the country anymore, thankfully. So, I think the question people might ask is, why is this different, right? So, well, I highlighted one or a couple of reasons, really. First, we've been here before, Jeff, right? We went through this in 2011. So that's a big difference. We don't have the European debt crisis. That's a big, big difference. Can you highlight some other reasons maybe why we wouldn't expect the market to react this way?
Well, I think about 2011, we were still working through an absolutely massive asset bubble in housing, right? Remember the collapse in housing certainly started in places like Marco Island and Reno and Las Vegas and Phoenix, and then eventually, really kind of traveled across the entire country. But, in these years that we're showing on the screen here, housing was a huge, huge drag for pretty much most, well, I'd say across the board for upper income folks, middle, lower class, wherever you find yourself in the income distribution, an asset bubble that's popping as it relates to housing, that is a tough thing to work through.
Yeah, and that feeds into why we were in a deflationary environment then, and now we're in the opposite, right? This is an inflationary environment. Back then, we had the Fed cut rates to zero. We had quantitative easing, 4 rounds of it. That was several years after this, before they finished, but we had a lot of QE with the Fed massively increasing its balance sheet. Well, now we're going the opposite direction. They haven't shrunk the balance sheet much post-pandemic, but they have shrunk it a little bit, and clearly they are pulling back on stimulus, not adding to it.
Right.
So that's a good segue to this slide. I'm going to steal your title as the segue master, Jeff, to show you the 10-year yield. So here we superimpose the 10-year yield path this time, right, this year versus 2011, and you see going in opposite directions, right? It's a totally different environment.
Well, I think, add other really unusual things happening in 2011 in the credit space, broader, fixed income markets. Think about subprime mortgages. We don't have that conversation today. We don't have collateralized debt obligations and collateralized loan obligations, all those instruments. And so, it's very, very different. Now, granted, you could kind of argue, well, look, housing was a bubble then. Isn't housing a bubble now? And I think I'd respond by saying, well, part of the challenge, it's not, we got to high house prices, not because of very easy access to credit, right? Zero down. If you could fog a mirror, you got a mortgage. In this case, you have a very tight labor market because people are moving around. Certainly, it started during the hybrid work environment. That certainly added all kinds of interesting stresses in the markets. Then, of course, no one wants to move. If you got a mortgage at 2.5%, why put your house up for sale now? So supply of homes is going to be constricted in the near term. So it's a lot different when you look at credit markets, lending markets. Those are some two, I think, very important variables to look at.
Absolutely. So, while this Fitch news probably put a little bit of upward pressure on rates, right after the news, I think the 10-year yield moved about 15 basis points over the next few days. So we'll attribute some of the move to that, but there's clearly more going on. We still think, as I mentioned earlier, that rates are going to find a ceiling here in short order and then move back down into the high threes by the end of the year. Consistent with what happens historically when the Fed stops hiking rates. So, so now the question is, well, what happens now? Is the U.S. debt problem going to get worse? And can the Treasury afford to pay the service on the debt and all that? Well, the answer, it's a good story now, right? Because debt as a percentage of nominal GDP, the interest on the debt for the U.S. government has actually come down in recent decades because of low interest rates. This number in the most recent quarter was 2.3%. So that is a good number. But as higher interest rates flow through to Treasury coupon payments on the debt, this number is going to get worse. if you look at the interest payments relative to tax receipts, it's kind of like revenue. I'll get to this on the next slide a little bit. The revenue the government gets is obviously how they pay the interest. That ratio right now is 13% and rising. And historically, when it gets to 14%, that triggers some tough decisions, or at least tough conversations in Washington. And maybe the bond vigilantes will come out again and push yields higher. So I think this is a good story now, but as we know, if the US government doesn't start addressing this soon, it's just going to get tougher and tougher over time. And, eventually the market's going to throw a tantrum. Now, I don't know what you think about timeline for that, Jeff. I think it's several years away still, but it's probably less than 10 before this becomes a real problem, right? And that's what we show on this chart. If the government just continues on its spending path, the deficit as a percent of GDP is going to go from 5.5 to 7.5, right? And at that point, if interest rates are higher, it really becomes untenable, and we'll have to start spending, cut spending. We'll have to do something with entitlements potentially. We'll have to raise taxes potentially, which nobody wants to see. How long before this becomes a problem, Jeff?
Yeah, I think so much of it relates to what's going to happen the latter half of this year and then 2024. So we know from history, going back, to the Clinton years and prior to that, when we had a federal surplus for a very short bit, so much weighs and relies upon steady growth. And so if we have kind of this short and shallow recession that may show up, and if it's a soft landing, whatever it turns out to be, but if it's short and contained, and so by the time you hit the latter half of 2024 or even 2025, there's enough kind of, correction to allow the economy to kind of, restart to something fairly decent. Now, granted, we're going to shift down to slightly lower growth path because of an aging population and a shrinking labor force. But if we have that offsetting influence of artificial intelligence keeping productivity rates up, maybe that, 2030 and onward graph doesn't look that bad. I think, Jeff, as you and I were talking about this earlier, you look at that gray line, which is deficit as percent of GDP, kind of hitting a little bit of that steep slope there after 2030. That's going to be very difficult to sustain, probably unsustainable. A lot of it relies on the blips of the next 2 years. So, yeah, it's interesting. Just a key takeaway, I think, from this is, it's about pro-growth policies, things that allow the economy to, thrive and have its, reach its full potential, if you will, and that's going to be really something that's going to emerge in the next, say, 24 months. That'll very important to how the growth path looks like in the next decade.
Yeah. So, whoever's in the White House in 2024 may, be in a more challenging situation at some point in their next term, especially if they're a two-termer, which they probably won't be, but we'll see. Too early to speculate on the 2024 election, but this is something that we need to start addressing in the next several years, or it's just going to get tougher and tougher. So good discussion there. Again, Jeff, as you highlighted, this was the topic of our weekly market commentary for this week, which you can find on LPL.com. So let's preview the week and then we'll wrap up here. So Jeff, we got a big week for retail, and it's not just the retail sales report that we get on Tuesday. I guess that'll be out by the time you listen to this. But we also have a number of retailers reporting earnings, right? Including Home Depot, Target, and Walmart. So I think we can debate. Maybe we have a different view on this, but I actually think retail is going to be a bigger story this week than the Fed minutes. What do you think? You going to take it?
I don't know. So I guess the reason why I'm taking the other side on that, Jeff, is, the minutes I think are going to help us get a little bit of that sneak peek on how the Fed was viewing this emerging trajectory in inflation, how encouraged are they going to be as they reveal, hey, look, the numbers are still too high, but are they happy about the direction? I think that's going to be important for investors long term, because we still have this disconnect, Jeff, that we've had for a very long time about what the markets expect rates might look like, the next 12 months, and what the Fed has projected rates in the next 12 months. The Fed's a lot more hawkish than what the markets think, and so I think the minutes will kind of help correct those views. We do know dot plots are poor predictors. Fed's dot plot, not a good strategy for those that want to put some bets on the table. But that's kind of my argument for why Fed minutes are going to be take the cake this week.
All right, you convinced me. I'll give in.
Not that easy. Come on, push back.
I'll continue to be an obsessive Fed watcher for just a little bit longer, maybe through Jackson Hole, and then I'm going to try to pay attention to other things. But obviously, for the market, the Fed is very, very important. And so if we do get hints as to what they might do, either in the minutes today or this week, or in Jackson Hole next week, that will be certainly very important for markets. So, other than that, it's just kind of the usual monthly cadence of housing data and jobs data and the leading index that we'll watch. But retail and the Fed, probably most important. And I think retail is important now because of the pricing power that's needed to maintain margins, right? I mean, we obviously want insight into the consumer and how consumers are holding up. That goes without saying. We care about that all the time, right? Consumer spending is about 70% of the economy. But what I think is a little bit unique this time is, in a disinflation environment, right? How are retailers going to be able to maintain margins, right? Because they don't have as much pricing power as they had a couple years ago. So we'll be watching that with the big players during retail earnings week. And that'll pretty much bring earnings season to a close, which frankly, I think has bested virtually anybody's expectations. And it looks like the earnings recession will be over next quarter. So with that, we'll go ahead and wrap. Thanks so much, Jeff, for joining. Thanks to all of you for tuning in on another LPL Market Signals. I'm glad we could be back with you. And of course, we'll be back with you next week for another edition. Thanks so much, and we'll see you then.